Hello and good morning, ladies and gentlemen. You're with Alex, Senior Account Executive at GDMFX, with your European Session Morning Outlook. We'll start with the North American markets. The dollar extended its decline against the yen on Friday, logging its worst 3-week stretch against the Japanese currency since June 2013. The USD JPY is 70 pips down on Friday, and we also had US inflation data. It's overall positive, and Canadian inflation data, which also came out overall positive. On the inflation, cheaper gasoline and moderating grocery prices kept inflation in check in January, but expenses for medical care and housing are rising. The CPI year-on-year came out 0.1% better than expected at 1.4%. The CPI year-on-year in Canada 0.3% better than expected at 2%. The ex-food and energy in the US 0.1% better than expected at 2.2%. And the Bank of Canada CPI core year-on-year is also 0.1% better than expected. Dow and Nasdaq are both sideways. Dixie is basically at the same level. So for today, we have Tier 2 news, Chicago Fed National Activity Index for January, and market manufacturing PMI data for February. By the end of the week, we expect most of the trading to be done on Thursday and Friday. Thursday, we have durable goods orders, and Friday, we have the gross domestic product from the US. All right, on to Europe. In the very near term, there is a heightened risk to the euro, as the calendar is packed with medium and high-ranked event risk on the horizon. Event-driven volatility, particularly between the hours of 9:30 GMT to 3 or 15 GMT, will be well represented over the next 2 weeks, starting with today. Today, we have preliminary February PMI readings for France, Germany, and the broader Eurozone will be released, and in aggregate are expected to show a further moderation in growth momentum. On Tuesday, the final fourth quarter German GDP readings are due, while the more relevant February German IFO will also be released and are expected to offer a mixed outlook on the Eurozone's largest economy. Despite these early week release, the euro will likely be influenced by the late week inflation data more than anything else on the economic calendar, as the core of the ECB's sole tenet of monetary policy. Incoming inflation data against a backdrop of markets anticipating a change in central bank policy should prove to be highly influential. On Thursday, the January Eurozone Consumer Price Index will be released and is expected to show severe deflation month over month, negative 1.4% versus 0.0% prior, and another print sub negative 1% year over year, plus 0.4% versus plus 0.2% prior. Preliminary February German CPI figures released on Friday will show similar price developments. All right, on to the UK markets. We had a Tier 2 event on Friday, public sector net borrowing. It came out £2.137 billion worse than expected at negative £11.813 billion. The pound rallied on Friday over the weekend after David Cameron secured a deal with the EU that meets his demands on welfare cuts, decision-making, and further integration. This way, the EU has given the UK a special status in the Union, with a close deal in hand to present his voters before the referendum in June. David Cameron was feeling good. The sterling rose 0.5% against the dollar and 0.2% against the euro. All of this was to be lost after Boris Johnson, Mayor of London and one of the leading politicians, announced that he will be backing the Brexit team due to the fact that he believes that Britain can get an even better deal. As a result, the sterling plunged with 0.9% against the dollar and 0.8% against the euro. This is an example of the price swings investors can expect prior to the referendum on June 23rd. The FTSE 100 lost 45 points on Friday and closed at 5,945. The 10-year gilt yields closed at 1.45% on Friday. Some movements: the pound against Australian dollar, 110 pips up on Friday, 150 range, and the pound against the Canadian dollar, 135 pips up on Friday, 201 pips range. No events for this week until Thursday, when we'll have the GDP, Gross Domestic Product, readings from the UK. Alright, on to the Asian and Pacific markets. We had the Royal Bank of Australia Assistant Governor De Bell's speech. The governor focused on interest rate benchmarks, domestic reforms around the principal interest rate benchmark in Australia, and the bank bill swap rate. So not that important news. Some news on New Zealand though, which is very important. Markets or market analysts have assigned a 100% probability the Royal Bank of New Zealand will cut once more the interest rate this year, and a 40% chance it will cut a second time. Inflation remains very low and inflation expectations are still fading. Pinpointing the exact time for the cuts is difficult, but hints are for June or August. Alright, the last sector for today, commodities. We had the Baker Hughes US oil rig count. It fell by 26 to 413 in the week ended February 19th. Oil prices sharply fell on Friday as market players continue to focus on a global supply glut and amid doubts over the likelihood of a collective cut happening anytime soon. Gold had a range of $14 at 1,217, going down. Silver had a range of 20 cents at 15.24 now. Crude oil had $1.60 range at 32.35 now. And natural gas is trading at $1.80 at the moment with a range of 7 cents. Alright, thanks for the attention everybody. I'll see you next time. Goodbye.